Hello and welcome to another episode of ETF 360. I'm Kirsten Chang, Senior Industry Analyst at VettaFi, and today I'm pleased to be joined by Maurits Pot, founder and CEO of TEMA ETFs. He's here to talk diversification and dive into TEMA's new S&P 500 historical weight ETF strategy, ticker DSPY, which just rolled out earlier this month. Maurits, it's great to have you. Thanks so much for joining us.
Thanks for having me on the show. Look forward to speaking today.
So first off, we hear a lot of talk about how top-heavy the S&P 500 is right now. We're talking historical levels of concentration risk. Just how concentrated is it exactly? Put that into perspective for us.
Yeah, it's a very good question. So if you look at S&P concentration levels today, the top 10 companies even post a sell-off for somewhere between 37 and 39% of the index today. And these levels we've seen twice before in the last 100 years, in the 1920s and in the 1970s. So we're at an unprecedented junction in terms of the concentration level we see in S&P 500 today. Now, concentration levels are high across several indices, but really what we've seen in the last few years is the rise and the proliferation of the Mag 7 have just further driven that concentration level to a point where investors are starting to ask themselves, did I want my core to be as concentrated? Is it potentially a risk? What can I do if I'm concerned about the concentration of what is less than 10 companies that represents such a large part of my portfolio?
Yeah, and so I guess put a little bit more background into it. Why is this concentration especially worrisome in today's market? You know, we saw how susceptible the Mag 7 were to deep-seek scares earlier this year, and obviously the market's had a turbulent ride given all the tariff headlines changing day to day, hour to hour. So why is 2025 a good time to diversify?
Yeah, it's a good question. So I think over the last few years, the market has really been driven by a small number of companies. But if you look at this year, we're starting to see that more companies are contributing to the overall performance or potential overall outlook for the market. So I think what people are realizing is that concentration risk was a benefit or was a tailwind for a number of years, but increasingly it's potentially now realized people are concerned about the concentration being a risk. Partly because the valuations of some of the companies at the top of the index are also quite expensive by relative and absolute terms. The Mag 7 was great in 23-24. I think 25 was revealed that the Mag 7 has risks. And one of those risks is concentration risk, and another is valuation risk. And if there were to be some normalization to the mean over time, how is the index positioned? And if we look back at history, the 1970s, there was a period when investors that were overexposed to a small number of the companies in the index, frankly, had a very difficult time with their portfolios. So I think the view is not that we take a bearish view on the Magnificent 7, but then what we do take a view on is over time, is there a chance that there's other companies that start to contribute to the overall index performance? And if that were to be the case, that would potentially reduce the impacts of the Magnificent 7, which based on current concentration levels would mean that overall performance index, frankly, could trickle for a while.
Yeah. And in your mind, why is the S&P 500 equal weight not an adequate solution to this concentration problem?
So historically, people would go to equal weight. Equal weight was invented 22 years ago by then Guggenheim, now Invesco. The challenge that people have with equal weight, which is a lot less appreciated, is how low the overlap is with full weight. So the overlap between full weight and equal weight is now down below 50%, which effectively means that if you're buying the equal weight S&P 500 ETF, you're taking a relatively active view against the full weight. And for most investors, when they're investing in their core, investing in the S&P 500 complex, they want to stay exposed to not just the 500 companies, but also at a weighting and concentration level that mirrors what they hopefully get in the index. So in the time where people are, one, worried about concentration risk, two, worried about the lack of overlap between equal weight and full weight, what DSPY does is solve both those issues. It reduces concentration in the core from top 10 being 38, 39% to 21%. And at the same time, it increases the overlap between equal weight and full weight from 45, 50% to 85% in the case of historical weight and full weight. So what it does is it allows you to stay invested in S&P 500, but with lower concentration levels, while still having, relatively speaking, more exposure to the largest and until recently fastest growing companies in the index.
All right, fantastic. Well, thanks for that run through. That does it for ETF 360. My thanks again to Maurits Pot of TEMA for joining us. And thank you all for tuning in. We'll see you next time right here on ETF 360.